Ora si registrerà la conferenza.
Okay, welcome to the 8th seminar of this series of seminars organized by Consul, ESMA, and bocconi on trends, risks, and in policies in securities markets. Today, we have a very important and topical issue to be discussed and to be presented in this paper by Nicola Borri about crypto markets and crypto assets that, as we have seen also in the latest weeks, they are still attracting a lot of interest in the market. We know that these are assets that are not yet regulated at EU level. So these are assets characterized by high volatility, much higher than all the other assets. These are a sector that pose some very important investor protection issues because of these reasons. And what I like in particular from this paper, and then I will be very brief because let's give time to Nicola to present, is that this paper tries to use the existing data to try to reach some conclusion, to do some assessment around these markets. And I think that it's really very important that for all the innovation topics where maybe we don't have very reliable and very known time series available for the analysis. I think it's very important that we try to use the data that are available to build some economic analysis, because then this can be used for any policy decision that is taken. And in general, working for a regulator, I think it's always good to try to build the policy decision on data and on analysis. And I think I will stop here, and I will ask Nicola to start presenting the paper. And many thanks again for having accepted the invitation to present this paper here. And yes, the floor is yours. Thanks.
Thank you very much, Claudia. Thank you very much, Ma, for the discussion that will follow, and everyone who's like Daniela, who's been so nice in organizing this seminar. So the title of this paper is Crypto Market Discounts, and I will explain soon what we mean by discounts. And it's a joint work with Kirill Shakhnov, who's also today in the audience and is at Sarri. So what we do in this paper, let me start with our motivation. So cryptocurrencies are a special asset in the sense that investors buy Bitcoin or any other cryptocurrencies like Ethereum, Litecoin, and so on and so forth on a multitude of exchanges. And these exchanges have the characteristics of being located in different countries, I don't know, from the US to Europe to Asia. And in order to buy these cryptocurrencies, they typically use different currencies in exchange. These currencies can be like fiat currencies, meaning they can buy Bitcoin using dollar, for example, or can buy Bitcoin using another cryptocurrency. For example, they can buy Bitcoin with Ethereum or Bitcoin with that. Now, something that investors are very aware of, in fact, there are many online forums where investors extensively discuss the crystallized facts, is that there are persistent differences in Bitcoin prices in different exchanges and against different currency pairs. Now, since Bitcoin is the same asset, so these differences are sometimes puzzling, and they might depend on frictions that prevent investors from exploiting these differences, or from other characteristics of cryptocurrency markets. And so this is the sort of question that we are after in this paper. Let me start with an example using our data. So what you see now in the figure is the so-called Kimchi Premium. What do investors refer to with the Kimchi Premium? They refer to the fact that sometime between the end of 2017, beginning of 2018, in Korea, on Korean exchanges, there were large differences in Bitcoin prices with respect to the price in other markets. So, for example, in the figure here, you see in black the average Bitcoin price that you can obtain in, say, in non-Korean markets. And then the other color line corresponds to the price in Korea, using Korean won in exchange to buy Bitcoin, in particular on BitAmp, on CoinOne, and Concorbit. So you see that toward the end of 2017, beginning of 2018, the difference between the black line and the color line opened up, and at the maximum, it arrived to almost 50%. So this is a large difference that it's hard to reconcile with simple story of market segmentation. And so this is just an example of the kind of phenomenon that we want to describe, and we will refer to as discount as the differences in Bitcoin prices across markets or currency pairs. Now, you might think, looking at this picture, that this phenomenon was very specific to, a few years ago, where cryptocurrencies were just born and markets were, and even less regulated than what they are now, maybe less liquid. But this doesn't seem to be the case. For example, just last week on the internet, there were news about the fact that the Kimchi Premium was coming back. And in particular, as you can see in this snapshot from the CoinDesk website, so the fact that, according to this article, the fact that there is this rising and large attention again on Bitcoin with the rapid increase in price in the last month has opened up again the Kimchi Premium, differences in prices between Bitcoin in Korean exchanges and in non-Korean exchanges. So this leads us to the research questions that we try to address in this paper. First, what are the implications in terms of efficiency of both cryptocurrency markets and cross-border payment system of these existing and persistent differences in Bitcoin prices? And second, what are the factors that could explain these differences? So these are the kind of questions that we are addressing in this paper. So let me first anticipate the main results of this paper, and then I'll try to be more specific. So first, in this paper, we discuss the distribution of the daily Bitcoin prices over time and across different markets, where by markets I mean different exchanges, and across different currencies that you can use to buy Bitcoin or other cryptocurrencies. I'm going to show you that there are large differences that range from -70 to 55% for fiat pairs, meaning Bitcoin to dollar, Bitcoin to euro, and to -20 to +20% for crypto pairs like Bitcoin to Ethereum. This is the range. Of course, the average will be much smaller, but the range gives you a sense of how big could be this phenomenon. Second, I'm going to show you that the overall variability in Bitcoin prices is explained by the location component, where I mean where the exchange is located. Almost half of the total variation is explained by this component, and 1/3 will be explained by the currency component, meaning which currency you are using to buy Bitcoin. Second, I'm going to show you that measures of counterparty risk, liquidity risk, blockchain and cryptocurrency factors can help to explain the dispersion in Bitcoin prices. But there is one factor, which is mining activity, that can explain at the same time the time series and spatial dimension of the Bitcoin price dispersion. Then, if you're interested in the paper, we also lay down a model that endogenously can deliver market segmentation in the short run and market integration in the long run. However, given the time constraint in this presentation, I'm not going to talk about the model. So let me briefly put this paper in the literature. So there is a new and growing literature, empirical literature on cryptocurrencies that was born with the cryptocurrencies. And these papers, for example, Makarov and Shor, have already discussed differences in Bitcoin prices and attributed them mostly to market segmentation. Investors cannot trade across these markets. Other papers like Liu and Sivinsky, for example, or Liu and some other co-authors show that they show the characteristics in terms of risk and returns of cryptocurrencies. With respect to this literature, in this paper, we study how fluctuation in counterparty liquidity risks, blockchain and cryptocurrency factors can explain this large variation in Bitcoin prices, both over time, across markets, and across currencies. Second, there is a literature well established on market efficiency and limits to arbitrage. So this is a literature that has studied many different examples of supposedly inefficiency in financial markets, whereby inefficiency means difference in prices between similar or same assets. So there is the literature on closed-end funds, Siamese twins, cross-listed stocks, currencies, and this literature usually explains these inefficiencies or anomalies either with the market segmentation, limited to participation kind of stories, or in terms of differences in risk. So this paper contributes to this literature because it's one of the first papers that considers inefficiency in a market for a truly homogeneous asset, because Bitcoin in Europe and in the US is the same asset, it's truly the same asset. While, for example, when you look at cross-listed stocks, they are not exactly the same asset. And Bitcoin not only is homogeneous and truly global, but it's also traded by a large number of investors. So let me start by describing the data that we use. So as I was mentioning at the beginning, so investors can purchase Bitcoin using either fiat currencies like dollars or cryptocurrencies like Ethereum in different exchanges across the globe. Now, these exchanges operate 24/7 every day of the week, including weekends, holidays, and they use the Unix timestamp to track time so that we can easily match prices for different exchanges in different countries in the world. So there are two kinds of exchanges. There are some exchanges in which you can trade both cryptocurrencies and fiat currencies, and typically in these exchanges you can deposit and withdraw fiat currencies, meaning you can deposit, for example, dollars. Okay, and then there are crypto-only exchanges in which instead you can only deposit cryptocurrencies. Now, in this paper, we will use as data only the first kind, the one that the cryptocurrencies and fiat currency exchanges, because the second kind, which is also very popular, has been subject to a lot of critiques about the or investors have questions the accuracy of the data, reliability of these exchanges. So we are focusing on a set of exchanges that are deemed to be good or reliable. So we collect Bitcoin price and volume data for these exchanges on a widely used data aggregator, which is Cryptocompare. And the longest sample that we use starts in January 1st, 2014, and arrives to January 1st, 2020. Now, the raw sample is very large. As you can see in this slide, we have a sample that contains 56 fiat currencies against the Bitcoin and 14 cryptocurrencies against the Bitcoin that are traded on 177 exchanges for the fiat and 113 exchanges for the cryptocurrencies. The number of pairs is much larger because on a single exchange, multiple pairs can be traded. And as you can see, the number of observations is very large. However, we need to do some selections in this sample to address issues that are very common in the literature on cryptocurrencies about data reliability. And in particular, as I was mentioning before, we only use data from we eliminate data from crypto-only exchanges. These are exchanges that have been criticized extensively for fabrication of volume data and other reliability problems, so we have preferred to eliminate them. We eliminate any observation that is associated to a zero volume. We eliminate pairs for which we have a very limited amount of observation, less than 31. Observation with a small volume, smaller than 0.1 Bitcoin, because they might be corresponding to pairs that are not very liquid. And we also eliminate the discounts that are too large, okay? So greater than 50% in absolute value. So this is the final sample. So final sample contains 27 currencies, fiat currencies against Bitcoin, and 5 cryptocurrencies against the Bitcoin, traded on a large number of exchanges, 83 for the fiat currencies and 42 for the cryptocurrencies. So the number of total pairs is 177 for the fiat and 116 for the crypto. Okay, so as you can see, the sample is still very large, even after the restriction that we impose to guarantee a better reliability of our data. So how do we measure these differences in Bitcoin prices? So as I was telling you before, investors can trade Bitcoin at time t in a set of different markets. So think, we denote markets with the M. Think of markets as different exchanges, like Bitfinex or like Coinbase, the famous exchanges where investors can buy and trade Bitcoins. So investors can use different fiat or cryptocurrencies to buy Bitcoin. And so we refer with P star as the price in market M against currency J at time t as the price of the Bitcoin. Okay, so the units of this currency J required to buy 1 Bitcoin in market M at time t. So we use the exchange rate S. So this is the spot exchange rate in units of currency J per US dollar to transform all the prices in US dollar by simply computing like the exchange by using basically the exchange. So PMJT is the units of dollars required to buy 1 Bitcoin in market M and with currency J. So all the prices will be in the same units. And we define Bitcoin discounts as the ratio between the Bitcoin dollar price in market M and for currency J at a specific point in time with respect to the average price across all markets and all currencies. So basically, the lower is D, the more cheap, in quote, is the Bitcoin price in that specific exchange against that specific currency. The higher is D, the more expensive on that exchange and for that pair is Bitcoin. So the denominator here is nothing more than the average Bitcoin price. So this table contains the description of this price distribution of Bitcoin prices. So here you see 3 rows that correspond for the sample of only fiat currencies against Bitcoin, only cryptocurrencies against Bitcoin, and all currencies against Bitcoin. So if you look at the first column, you have the standard deviation. So you see that in the entire sample, the standard deviation of this price distribution is 5%. Okay, and it's larger for fiat currencies, 6%, than for crypto. The range of discounts is very large, as you can see. Okay, this is the gross discounts, and so discounts consequently go from plus 50% to minus basically 70%. And the distribution is typically negatively skewed. Okay, kurtosis is very large, indicating the presence of very thick tails and very large extreme deviation in the Bitcoin price. And these discounts are also very persistent. In the sample of all currencies, the simple autoregressive coefficient when you fit an AR1 to the discount series is 0.46. Okay, and it's larger for the fiat pairs, 0.5, and smaller for the crypto pair. So this picture summarizes also the information about these Bitcoin discounts over time and grouping the exchanges in different regions of the world. We will talk about locations in this paper where we mean regions of the world. You see here in the legend this region. So you see that with the different shades of color, you can see that the discounts fluctuate a lot. They do not disappear, they don't diminish over time, okay, from say 2014 to 2020. And discounts are not specific to one location in the world, but are common in most locations in the world. Now, we're talking about discounts in crypto markets, but how can we make a sense of how big they are? So it is useful to compare the numbers that I show you, so this large range discounts from, say, for fiat pairs from -70 to +55, and from crypto pairs from -20 to +20, to discounts in other markets, in more traditional markets, okay? And for example, there is the literature that look at ADR that shows that the average discount is very small, 5 basis points, but also for ADR, which are traditional and traded on very regulated markets, you can observe extreme deviations as large as -40% and as small as -40% and as large as 127%. Similarly, researchers that have looked at discounts between H shares in Hong Kong relative to A shares in mainland China have found the discounts up to 75%. Instead, in the currency market, there is the literature that has looked at deviation from the covered interest parity, and it's also find deviations, but smaller, between 6 to 19 basis points in very recent research. So we want to deconstruct these Bitcoin discounts to understand what can explain their variability. And it is convenient to start with an illustrative example, and then I'm going to use this. I'm going to do a more systematic analysis. So for this example, I'm going to consider just one random day that I pick. We pick Wednesday, June 20, 2018. It doesn't matter which day you pick. And I'm going to start by showing you some results for only the Bitcoin to dollar currency pair across different markets. So in this case, there is no exchange rate risk because all pairs are against the dollar. Then I'm going to include in the sample for just one day all the fiat pairs. Then I'm going to include all the additionally also the crypto pairs. And then I'm going to consider the full time length of the sample from January 1st, 2014 to January 1st, 2020. And so these 4 histograms describe this example. So in the top left panel, so you see the case in which for this single day, you have only USD Bitcoin pairs. So this is 20 observations. The volatility in the price dispersion is about 1.3%, and the range in discount goes from more or less -1% to +5%. So even when there is no exchange rate risk, all the pairs are against the dollar, we observe discounts. Okay. In the top right panel, for the same day, we consider all the fiat pairs against Bitcoin. Okay. Now we have about 70 observations, and the volatility increases to 2.2% volatility of the price dispersion, and the discount now range between -10 to +10%. In this bottom left panel, we additionally include also the crypto pairs. Now the volatility drops a bit to 1.8%, and the range of discount is similar, -11% to +10%. And finally, in the bottom right panel, we consider the full time sample, all pairs, and now the volatility increases to 5%, the number from the table before, and the range in discount goes from -70 to +50%. So this is just an illustrative example for one day, okay? But in general, this example teaches us that the dispersion in discounts might depend on heterogeneity across the exchanges locations, like exchanges located in, say, Korea versus the US, across currency pairs, for example, pairs against the dollar versus pairs against the euro, and of course over time. So the data that we have allows to decompose these discounts or log discounts in market M, currency J, and AT into three components that you see here in three different colors. Okay, here the lowercase letters correspond to the log of a value. So what's the interpretation of these three components? The first component, the one in red here, is basically the relative price of all pairs trading location G, say Asia, with respect to the average Bitcoin price. The second component, the one in blue, is the relative price of all pairs J, say against the dollar, traded in location G, say in Europe, with respect to the average price of all pairs traded in the same location, so all pairs traded in Europe, for example. And finally, the magenta color term, the last one, represents the relative price of each pair with respect to the average price of pair J in location G. Now, we can take the variance of this expression here, and if you do that, we can compute the relative contribution of each of these three terms, location, currency, and then the residual term, to the overall variance. And what we find is that the location component accounts more or less for half of the variation, 52% on average. The currency component to about 1/3, 31%, and the residual component to 18%. These are averages, okay? But we observe also large variation in the contribution to the overall variance over time. So the red part here is the location component, for example, and you see that it's clearly the largest, but its importance has declined a bit over time, and anyway there is variation, and also the green part, the currency component, sometimes assumes has a very large contribution. So we want to explain these Bitcoin discounts, and in order to do so, we estimate time series and panel regressions to investigate the contribution of observable factors to the variation in Bitcoin discounts over time and across different markets and currencies. Now, in the paper, we consider a large set of candidate factors, and we are going to group them in 4 categories that now we'll discuss in greater detail in the time I have left. And the 4 categories are counterparty risk, liquidity risk, blockchain factors, and cryptocurrency factors. So now I'm going to discuss each of these categories in the aggregate, even though in the regressions, we're going to use, whenever we can, factors at the location level. Okay, so for example, I'm going to talk in a second about it. So let me start with counterparty risks. Now, how do cryptocurrency exchange function? So they function many ways like broker or banks, because customers buy and sell Bitcoin, but they maintain a balance of both fiat currency and Bitcoin at the exchange in a shared account, which is called wallet. Okay, and all trades on a given exchange are completed off the blockchain. Okay, so they're not recorded on the blockchain. So this means that investors are exposed to the risk that something bad happened with the exchange. The very famous and disastrous example is the bankruptcy of Mt. Gox at the beginning of the life of Bitcoin in 2014, where at the time $450 million worth of Bitcoin were stolen. But apart from these spectacular events, there are often problems with exchanges that can be bankruptcy, can be temporary or permanent shutdowns, and so these are examples of counterparty risks. And so in order to measure counterparty risk, we will consider 4 measures. We're going to consider Bitcoin wallets, which are like deposit in a bank. We're going to consider a bankruptcy indicator, the amount of Bitcoin stolen, and then a regulatory shock indicator. So in this picture, we summarize a bit these factors for counterparty risk. So you see the wallet, which is a measure of the, if you want, of the reliability of the exchange, of the asset of the exchange, have increased up to 2018. Then there is this sharp drop, which corresponds to the period of drop also the Bitcoin price, and then a subsequent increase. If we look at the other quadrant, you see the amount of Bitcoin stolen, Okay, and even in more recent times, we have large examples of problems in exchanges. In 2018, famously, the coin check was hacked, and about 0.3% of Bitcoin supply was stolen. In the bottom left panel, you have what we call bankruptcy shock. So this the black line corresponds to permanent elimination from our sample of pairs, which disappear because of, for example, a bankruptcy or other problem to that pair. And finally, in the bottom right panel, we have what we call regulatory shocks, that we collect combining data from our classes and manually collected data from Cointelegraph. So here, a +1 means a favorable regulatory shock, and a -1 unfavorable regulatory shock. Then we consider measure of liquidity, where liquidity is considered as the possibility to liquidate the position in a timely manner at a reasonable price. Here we consider classic indicators like volume and bid-ask. And here in the top panel, you see the time series of the aggregate volume, even though in the regression we will use also volume at the location level. And so here, it's interesting that you see that on average volume is relatively large, about 12,000 a day, but we have this huge drop at the beginning of 2017 that correspond to unexpected change in regulation in China that produced a large drop in the volume of transactions. And in the bottom you see bid-ask spread. Also here you see that bid-ask spread is relatively small, about 1%. And maybe you'll be surprised, this is the average, you may be surprised that it doesn't decline over time. And indeed, it does decline for many pairs. But at the same time, in the data, we have new pairs entering the sample, and typically the new pairs have a larger bid-ask. And that's why, on average, you see that there's not too much decline in this bid-ask. Of course, in the regression, we will have bid-ask at the pair location level. Then we have blockchain factors. So there is a current literature that studies how characteristics of the blockchain, like computing power and network size, are related to the security, are related to the security of Bitcoin and so to its value. And here we consider the following indicator: time to transact, value of transactions on the blockchain, mining fee, and hash rate. And here you see a time series of these 4 indicators. So given that we are getting short with time, I'm going to focus mostly on mining fees, which will import in our regression. So this is a combination of block rewards and transaction fees. So the block rewards capture here the levels. So here the jump, for example, correspond to the halving of the block rewards in the blockchain, and the variability correspond to the transaction fees that miners receives. Also, in this case, in the regression, we will have a measure that is location-based. Finally, we have cryptocurrency factor that capture demand and supply of Bitcoin. And here we will consider the price of Bitcoin, the Google searches for the word Bitcoin that capture the interest of investors, and finally, capital raised in ICOs. As you can see, in the later years, there is a substantial amount of capital raised in ICO, initial coin offer. All in 2017, about $3 billion were raised in ICOs. So I'm going to show you quickly our estimation result. So I'm going to show you 2 tables. The first contains time series regression, in which we regress the cross-sectional variance of log discount across all exchanges and pairs. Okay, and here you see that we report result at daily and weekly frequency. In this table comes from a regression in which we have a lot of controls. Here, for reasonable space, we put the control only that are more interesting for us. But in the paper, you will see the table with all the controls, and you can see that. These factors explain about 1/3 of the variation, and once we add the persistent, the lag of the dependent variable, the explanatory power of the model increases a lot, suggesting that there might be persistence in the discount and so some degree of market segmentation. And you see that basically larger bid-ask spread the banknote indicator contribute to larger dispersion in discount, while larger mining fees or larger ICO amounts, which we associate to a larger supply of Bitcoin, correspond to a contraction in the overall variance. The last table I'm going to show you contains a panel regression in which the dependent variables are the location-specific means of discounts. And here, I'm going to highlight the importance, again, of mining fees that are significant and enter with a negative sign, suggesting that Bitcoin are cheaper. Remember, lower discounts meaning cheaper Bitcoin in a specific market. Bitcoin are cheaper in markets where there are a larger amount of mining fee collected. And so we interpret this as a supply effect that brings down in a specific market the Bitcoin price correspond to the other markets. So let me conclude, since I'm out of time. So this paper studies the distribution of Bitcoin prices over time and across markets and currencies. We decompose the variance of discount in three components: time, location time, and location currency time. And I show you that the spatial dimension explains on average more than 50% of the total variability. I show you a set of measures of counterparty risk, liquidity risk, blockchain and cryptocurrency factors that can explain the dispersion of Bitcoin prices. However, in this paper, we focus a lot on mining activity, which we show to be the only factor that can explain both the variability over time and across location of Bitcoin price dispersion. So thank you. I hope I was not out of time, and I'm ready also to answer questions later.
Many thanks for discussing your paper. It's Nicola, the result of your model are very interesting for regulator, also for practitioner. And I don't know if now there are some questions regarding the result of this very interesting paper. Otherwise, you can move to the discussion of the paper.
Okay. So if I may start. So first of all, Nicola, thank you for your presentation, and thanks to you and to your co-author Kirill for bringing up this topic. I think Maha will agree that we who work every day with DLT related topics, we can only encourage and support those kind of topics, and that's why I think we see the big contribution of your paper to the academia, because it's a quite new area, and new articles and papers on this topic can be only regarded as a big contribution. So thank you for that. The second, which we find quite good and interesting, it could serve as some kind of recommendation for investors. So it gives some light on as you said, Kimchi Premium, and we raised this kind of question to you. We wanted to raise this kind of question to you, but you answered during the presentation. We wanted to know if this Kimchi Premium exists today or recently, and then you answered actually the question, because I think, Maha, we haven't got the latest version of the paper. I think we had the previous version, so thank you for that. What we think it would be worth mentioning is maybe kind of predefinition of some parameters. When you talk about liquidity risks, you mentioned about the large and small spreads. So it would be good that we know what are the thresholds of large and small. So I think it will, in terms of complexity, will help us to understand it more. And also, I think during the paper, I think you are using interchangeably terms wallets and exchanges. So, I mean, it's often the case, but it might not be the case, yeah? So we were wondering if this could affect the results somehow of the paper. So in that regard, Maha, do you want to add something?
I can just second what Nicola has just said. Allow me to first start by saying wonderful work, very early thought process and leadership thought in the way that you presented some of your arguments. I have a minor remark, if I may. I just found it pretty interesting that you decided to use Google Trends for data. While we are completely aware that with Bitcoin and cryptocurrencies, there is a huge lack of transparent, granular, and let's say accurate data. But with Google Trends, it might not be the best indicator, because in a lot of cases you might be looking into it, but the results of actually purchasing or conducting a trade with that can be misrepresented to a certain extent. However, there is a light in the horizon, especially with the introduction of the digital finance package by the European Commission, and more specifically looking into the future proposed regulation of MiCA. Hopefully this gap will be filled by the authorization or the licensing of crypto asset providers, where we would be required to provide better data to the market, and therefore it would be really worthwhile to revisit this research and compare how the European market would react given that cryptocurrencies could be considered an asset reference token, which would be one of the financial classes of assets under the MiCA regulation, providing more market clarity, investor protection. And it will be interesting to see if this would translate to the price efficiency that you have mentioned. This is it from my side. Nicola, have we missed anything?
I think this is what we will discuss, Maha.
Yeah.
Thank you. Thank you. Thank you very much, Nicola and Maha, for your thoughtful comments. Yeah, let me briefly respond, and then I don't know if there is any other questions, comments by the audience. So regarding the BDASK, how large? So yeah, we don't take a stand of how large. So let me say that. And this is also related to the comment by Maha. So the data is not often great in the sense that we don't have, for example, BDASK data on all pairs. So we have to estimate with predictive regression some of the BDASK. And also there is a large heterogeneity in the BDASK spread between more liquid pairs and less liquid pairs. Okay, so there is not only variability over time, but there is also a lot of cross-sectional variability across exchanges. And clearly, this BDASK spread can contribute to like preventing the absorption, basically, of these price differences. Regarding the Google thing, the Google Trend thing, I mean, yeah, fair enough. It's an imperfect measure. It would be better to have, for example, data on the individual registration to the different exchanges. So we would like to have that, but yeah, it's not available. The nice things of the Google Trend data, you know, as much as being imperfect, is that we have it at the location level, and so we can use it in our panel regressions as a measure of local demand, basically. You know, clearly, like not perfect. But again, thank you very much for your comments, for reading the paper.
It was our pleasure.
Thank you.
Many thanks, but I think that now it's very important to present in particular both Nicola Ristic and Maya Shadi from Deutsche Börse. I don't know. I think that it's also useful to share the slide in order to make a presentation of a discussion. It's very useful for the audience. I don't know if you think so. And but I'm very happy to present your discussion. Just a few words for the audience. Maya and Nicola come from Deutsche Börse and are very expert in area of European regulation in many areas, but in particular on cryptocurrency, blockchain, digital assets, stablecoin, smart contract, and so forth. So if you agree, I don't know, we have a little bit of 10 minutes. We can share the slide if you agree. I don't know if you think it's better to do this. I think I asked this to Maya, and to Nicola.
Well, the slides contain basically what we just said. So
okay.
I mean, we just raised the most important points from the slides, but I mean, in terms of sharing the slides, we don't have anything or.
Of course, we can share them. I cannot pull them up right now because I do not have access to the version of GoToMeeting that will allow us. But if you'd like us to talk you through them, would be more than happy to do so.
But as I said, this is what we discussed, just discussed, yeah.
Okay,
yes.
Okay. See, yeah. No, there is no other information, or very important information. So I don't know. What do you prefer? It's also Nicola, if you think that it's fine, and we can go on, and so to ask to the audience if there are any other question or suggestion or comment. Okay. Okay.
Yes.
I don't know if there are other participants that would like to say anything about this very interesting paper.
Yes, Daniela, this is Carlo.
Oh, thank you. Welcome, Carlo. Please, the floor is yours.
Yes, thank you very much for the paper, and very interesting. I have a question. Since you have a very interesting and in-depth analysis of the mapping of the cryptocurrencies, the question is whether you have detected, or if in the literature there is something concerning the lead-lag relationship among these cryptocurrencies, so that you can probably focus on those that may play probably a leading role in the price formation process. And the second is related to what the discussant says. So whether there is something that could explain the variance decomposition in terms of components that are typical of the equity side. So, because as you know, from the regulatory side, we are very interested in possible correlation between financial instruments at large and cryptocurrencies. So in that case, we should have some overlapping in the regulation. And so thank you for sharing your experience about that.
Thank you very much for your two comments and questions. So with respect to the first, we do not look at a lead lag relation, and I'm not aware of papers that look at this. I think that it's a very interesting question. I suspect that to answer the question, it would be more important to have higher frequency data. So we have daily frequency data. Probably it would be interesting to perform this analysis at a higher frequency and see, for example, if there is a lead lag relationship. across different pairs or across different markets. I don't know, Asia is leading or lagging, for example, Europe. But it's something to think about. Regarding the second question, so there's some research that looks at a little bit like in the traditional markets, that looks at the risk-return relationship in cryptocurrency markets using factors like people do in for example, in equity markets, like the Fama French factors. And here, this literature finds that, and this, for example, is the paper by Liu and Svitsky, they find that cryptocurrency markets are mostly disconnected from traditional markets, and so that the risk-return relationship is mostly explained by crypto-specific factors rather than, say, the US equity market or VIX or something like that. In this paper, we mostly focus on characteristics that are specific to different locations of the exchanges or of the different currency pair that is used to buy the Bitcoin, to explain the differences in the Bitcoin prices. So this is basically differences in Bitcoin price at the same time. In principle, if there was no frictions, like no transaction cost, if it was possible to transfer money across exchanges instantaneously, then these differences in prices should not exist, because the asset is the same. Now we know that these frictions instead do exist, and so we try to explain what are these frictions, which one is more important to explain the variation in Bitcoin price.
So can I add something to the answering these questions? So yeah, there obviously there is some literature on price discovery on cryptocurrency market, and they often show that sort of like if you ask like how other currency responds, then like basically the Bitcoin often leads the movement in the other currency. If you ask in terms of like across geography, then there is, I mean, apart from like really big shocks, like now when we study regulation shock in China, when the regulator in China prohibited basically Bitcoin trading, then we have a large spillover effect in other markets, in particular in the other market which is next proximity to China, such as Korea and Japan.
This is Kirill, my co-author, by the way.
And going back to regulation, like this Mika thing which Maya mentioned, I was wondering in the sense that, I mean, in this paper we show that regulatory shock are important to some extent explain the price differences. But I guess given that this asset is truly global, the regulator across the globe have completely different approach even in classifying this asset. Some classify this as commodity, some classifies as digital currency, some classifies as token. So I guess, and to some extent, many exchanges, they operate across like more than one geographic location. So kind of unifying regulatory framework would be probably would be helpful. Thank you.
Okay. I don't know if there are other questions from the audience.
Yes, sorry, Daniela, this is Carlo Milia from Consul, and
Please,
I have still a question on the whether you have detected some impact after the introduction of the future on the Bitcoins. So whether the listing of the future has played a role. Thank you.
Okay. Thank you. No, I don't know if Kirill can help me with this. I remember we checked if the introduction of other cryptocurrencies, other exchanges matter, and we didn't find a large effect. I don't remember if we also look at the future. Kirill, do you remember this?
In this paper, we didn't look at the future.
No, we didn't look. Yeah.
With one of my students, we look a little bit into this question. And but again, like there are kind of several introduction of futures. So like, but few, I mean, and also actually options. Like, so there are futures which were introduced in unregulated exchanges and then on regulated exchanges. And they typically, like, if you sort of, I mean, just eyeballing plotted data versus the booms in Bitcoin, so they sort of predecease the boom. But in this paper, we're not particularly interested in like trying to sort of explain the dynamic of the aggregate price. We're more like interested in explaining the cross-section discussion. So yeah, but potentially, I guess it might have impact. So I like basically with my student, what we did, we simply estimate simple Garch regression before and after introduction of futures and options, and there are differences in terms of volatility slightly reduced, and there is a effect on the mean estimates. So basically the price growth, so sort of slightly increase.
Thank you very much.
Many thanks for this discussion. Very interesting. I don't know. I think the time it's at the end. We have at 4. At 4 we will finish with this webinar. So I think this I would like to give many thanks to Nicola, Borri, and Kirill also because it was very interesting to have both authors of the paper. It's a very special webinar. Also, was a very special webinar because we have two very great discussion but Maya and Nicola Ristic that are very expert in this topic. This topic is very important. It's the future, and we know that it's a topic that are very changing, and so it's very important to have this kind of study and also in the future. I would like to thank you also for the question, in particular from Carlo Milia, and to thanks also to Nadia Linciano, is the head of the economic department that organized all this conference, Bocconi Esman, and finally, Claudia Guaiano that will open this very interesting webinar. Great, thank you to all, also for the audience, for the time to give this webinar. Thank you so much from Daniela Costa. Thank you.
Thank you, Daniela. Thank you very much.